So yes, good morning, good afternoon, good evening, everybody. Thanks for joining me today. It's really exciting to kick off this new range of series we'll be doing, where I'll be hosting Q&A sessions with a range of experts within Klein. The goal is to address the most challenging and relevant topics in the lubricants industry today and allow you, our audience, to engage with us along the way and engage in the discussion alongside us. So as Vera mentioned, today we'll be talking about base oil, and then the next session will be next month, and I'll be in Q&A session with Jana Wilkinson, who is the head of our energy management consulting practice. So firstly, let me just introduce myself and Ian a bit further. We're both part of Klein's energy team, focusing on the lubricants value chain and specialty products. You likely know our syndicated report team very well, led by Melinda. But Ian and I are from, as I say, the management consulting and custom research practice, where we help clients with everything from growth strategy, market entry, acquisition searches, and all sorts of other bespoke research and custom insights. My role is the Global Business Development Director, and I've been at Klein for over 5 years. And prior to that, I ran the PIMS Lubricants and Greases benchmarking project, which optimizes productivity and costs in lube plants, hundreds of lube plants all around the world. Earlier in my career, I was actually a wastewater engineer in Christchurch, New Zealand, before moving to London a bit over a decade ago. My esteemed colleague with me today is Mr. Ian Moncrieff, who is a Vice President at Klein's Management Consulting Division, where he focuses on fuels and base oils in the company's energy practice. He's got more than 50 years experience in the energy field, covering the complete value chain for liquid and gaseous fuels. He's worked in over 50 countries during his career for private and public sector clients worldwide. Prior to joining Klein, Ian worked for BP in corporate planning, then spent nearly 30 years with Arthur D. Little, where he was a Vice President of the energy practice and a member of the main board of directors. So thanks for joining me today, Ian, to launch this new format. So
thank you.
The agenda today, today I'm going to pick Ian's brain and delve into what's been happening in the base oil supply and pricing recently. This whole kind of way we're doing this has actually been a little bit inspired by an article Ian wrote last month, talking about the base oil pricing situation and how we've ended up there. So some of you may have read the article and others may not have. So the first part of our time together today, I'll try to bring us all up to speed on the key insights from that paper. Then we'll spend this next part of the session, I'm going to ask Ian what's happened since he published that paper about 6 weeks ago. And then ask some more strategic questions about what this all means going forward. I'll be incorporating your questions as we go. A lot of you sent some questions in advance, so I've already sort of scheduled those in, but I'll also be looking to the live chat box, and we'll try to incorporate those questions. Oh, sorry, not the live chat box, I shouldn't say that, the Q&A box, please, as Vera said. Try and use the Q&A box for questions, not the chat box. And then, so be patient if I don't get to your question straight away. Certainly the second half will be a bit more fluid, where we can be talking, I can sort of move to the Q&A box more. So without further ado, let's get started. So let me share, not quite yet. So Ian, you published this article with a very nice title that we all loved, which is Base Oil Everywhere, Nor Any Drop to Buy. The curious case of how coronavirus created a lubrication crisis. And this article talked us through some of the reasons why this explosion in base oil prices has happened. So what was it that really drove you to write this article, Ian?
Well, Annie, thank you for that introduction, and welcome to everybody who's on this call. I think those of you who've listened to me speak at conferences over the past years have understood that I always try to have a potted view of the reasons why various things are happening in the industry, and this one defied logic, because we are simultaneously in the midst of a major overcapacity situation in the base oil industry, and at the same time we have a price explosion caused by shortages of supply. And it is that anachronism which caused me to really try to put to paper this very diverse and apparently conflicting set of circumstances. And those of you who are literary by nature will remember the rhyme of the Ancient Mariner, written by Samuel Taylor Coleridge, from which the title of this paper is extracted.
Thanks, Ian. Thanks. Yes. So exactly. So this capacity issue in the article, you remind us. Let me actually share my screen because we've got a nice slide to share. So you reminded us of the history of base oils, and specifically the dramatic change that's happened in base oil capacity over the last 20 years due to the growth in high performance lubricants. Group 1 has gone from almost 75% of total base oil capacity to around 30%, and conversely Group 2s and 3s have quadrupled their share. So what has been some of the side effects of this dramatic change, Ian?
Well, good point. I think one of the challenges of this table, as you see it, is, yes, there has been growth of something of the order of 25% in base oil capacity during this 20-year period. But lubricant demand has not grown at that pace. In fact, demand in 2017 was essentially the same as it was in 2000 and zero. It increased a little bit with a peak of a little over 40 million tons in 2019, and declined. Our initial thought was that lubricant demand dropped by about 5 million tons in 2020 from 2019. We're probably going to up that number a little bit based on further information that's coming in. But the bottom line is that if you compare the relationship of capacity to lubricant consumption in 2000, we had something like 1.1 times world base oil capacity in terms of lubricant equivalent. Today we have 1.5. Okay, so that gives you a measure of the excess capacity we have for base oils in the market today. Okay, and yet we have this anachronous situation where and I know there are a couple of traders on this call where they'd love to be able to get their hands on any cargo of oil in the marketplace today. So yes, we have this very strange situation of a fundamental structural excess of capacity, and yet it's very hard to buy product today.
Thanks, Ian. And I think, as we go through this, and your article did a great job at helping us understand, why that is. So, one of the things you shared with us in your article was about how in the past, our ability to forecast base oil pricing, has been relatively accurate, barring any unforeseen circumstances such as floods and fires and hurricanes. And it's based on, fundamental algorithms linked to crude pricing and capacity utilization, arbitrage costs, and process economics. So, of course, one of these truly unforeseen circumstances has and is COVID. Where, let me just flick on a slide, trying to multitask, where last year we saw on the chart on the left showing us the decline in consumption of total oil products. And so we can see globally there was almost a 10% decline in consumption of total oil products, which of course led to much lower operable refinery utilization and ultimately negative cash margins, as you can see in the chart on the right. Towards the end of last year, the refineries were operating with negative cash margins. So if we bear that in mind, as we now, as Ian says, look towards what happened in the finished lubricant market, to finished lubricant demand last year, we at Klein estimate around 13% decline from 2019 to 2020. But to understand the full picture of why we're here today, we have to dig a little deeper and see what was actually happening on a month-to-month basis. So,
before we go up back, can I go back to that? There's
Please.
A point here I want to make, Annie, okay, and that is this. We need to think about the relative dimensions of oil products consumption relative to lubricants, right? We tend to forget that because refineries are focused on mainline products. lubricants and base oils are the tail that's wagged by the refinery dog, as I said in my article, not the other way around. Okay, so in broad terms, okay, we have world oil demand the first quarter of this year is going to run at around 93 million barrels a day. Okay, the demand for lubricants in the first quarter, even going back to on the assumption that we're back to almost pre-COVID levels of consumption of lubricants, is about 800,000 barrels a day, or less than 1% of total oil demand. So I think that sets the picture in perspective as why there are maybe things going on in the bigger picture of oil demand and refinery economics that dictate what's happening to lubricants and base oils.
Yes, yeah. Thanks, Ian. So yeah, so when we look at what happened to lube demand last year, here we're looking at the top 5 EU countries and also the US, and we can see that this is the ratio of actual to predicted monthly lubricant consumption. And we can see, of course, when COVID hit in March and April in these countries, there was a decline of almost 40% in lubricant demand consumption. And so then we see, some moderate recovery through May, but then by the back end of the year, it's pretty much back to pre-COVID levels. And in the US, even sort of making up for some pent-up demand. So to Ian's point, if we look at this next chart, here we're just looking just at the US, and we can see lubricants in the blue chart, blue line, showing that exactly what we saw on the last page, that by the end of the year, we were back to pre-COVID levels on a monthly basis. But the total oil products demand is yet to recover. So Ian, I take one of your sort of open questions from your paper and repeat it straight back to you and say, could this relatively rapid demand and rebound in base oil demand be a contributing cause for the price explosion that we've seen occurring over the last 9 months? For a big question for you.
Well, yes. In a nutshell, the answer is yes. I think it's certainly one indicator of the issue that we're now facing, because as you can see, what we believe has happened with lubricants demand is that that after the initial shock, lubricants lubricants are a necessary medium for sustaining industrial and economic activity. The demand for lubricants is essentially price inelastic, and essentially what's happened here is the initial shock of the coronavirus, once it was worked off, resulted in a very rapid rebound in lubricants demand, as shown here. In fact, the traditional December destocking that occurs, throughout the industry, typically at the end of every year, did not happen this year, simply because people were rebuilding inventories, and that explains the upward tail of the lubricant chart at the end of the year. So we are pretty much back on track as far as we can tell, at least in the US and Europe, where we can track on lubricant consumption with reasonable within a reasonable time lag. Obviously, most countries around the world do not publish, real-time or even relatively recent estimates of lubricants consumption or base oil disappearance, or however that's measured. And so very often we have to rely on longer-term means of assessing changes in lubricant demand. But certainly amongst the major EU countries, Japan and the US, for example, we can track, with a reasonable degree of relevance to the current situation, what's happening in lubricant demand. So yes, we haven't, and this pattern has been exhibited both in Europe as well as North America and in other parts of the world where we have relatively developed economies. And so bottom line is, we have seen lubricant demand rebound faster than that of oil products as a whole. And the challenge here is, of course, that refineries are driven by the demand for oil products, not by the demand for base oils. And therefore, a lot of what we've seen in terms of the shortages of product arising in the base oil market are driven by these fundamentally big picture refinery dynamics.
So on that point, Ian, I've got one more chart for today, and then we'll probably potentially not have any more. But there's this chart here, Ian, showing in the US Gulf Coast VGO price over, and so I think this is where I sort of want to use this chart to help also talk about what's happened since you wrote the article in sort of early April. So what's really happened in the last 6 weeks? Has anything sort of dramatically changed in terms of what the kind of things we were seeing as when you wrote the article?
Well, I think before I talk about that, let's go back a little bit in time. Throughout 2019, we saw in price formation pretty much what we would typically expect, you know, of the base oil industry in a long market, which was that margins over vacuum gas oil were, you know, ranging from roughly $100 to $150 a ton. Okay, that's the norm, and that margin has come down over time because of the increasing surplus of capacity worldwide. Okay, so going into 2020, you know, I would say that, you know, barring you know, unusual circumstances, you know, that would have been the market situation that we would have expected. Then COVID hit, and the immediate aftermath of COVID was that that base oil prices, simply because demand dried up, base oil prices, as reported by pricing services such as ICIS or Argus, remained static, simply because there was no trade on which to report pricing, and therefore the margin over VGO, which is much more responsive to changes in crude price, increased substantially, and that's that blip you see in the early part of 2020. It was a theoretical blip because there was no trade on which that margin was theoretically available. Then, of course, you know, then of course we got into the real meat of COVID, dramatic drops in consumption and a decline in base oil prices at that time. So margins over VGO dropped to very low levels for a very short period of time. So we went from one extreme to the other, and now we've gone back in the opposite direction. You know, we could see, for example, that Motiva, for example, reduced its posted prices from over $3 for, let's say, for a neutral 200 grade, from over $3 in the beginning of the year to a low of 211 in March of 2020. And now that price is back up to almost $4 a gallon. So, you know, the industry has responded to this. But more importantly, I think what we see here is this huge explosion that's taken place in pricing in the last quarter, where now we have a situation in round terms where, let's say, a Group 2 mid-grade, say 200 neutral, is selling on the Gulf Coast at around $4 a gallon, you know, compared with diesel at a little under $2. So we have a $2 a gallon margin between base oil and diesel. The costs of operating a refinery differently, variable costs to make base oils as opposed to diesel would be nominal. And the obvious question, therefore, which this chart poses is, well, why don't refiners react to this situation and make a little more base oil and a little less diesel?
Yes, yes.
And now, to the second part of the question, what has changed since I wrote the paper? The answer is not a lot. We've been plagued by a series of random and untoward events over the last a little bit over a year. Okay, COVID is obviously the leading one, and it continues, but it's not the only one by any means. In fact, as my good friend Joe Romanier, who I think is on this call, said, we're suffering that however many plagues that Egypt had, I've seen 6, 7, or 10, but however many plagues there were, we seem to have suffered a number of them in the US this year. So in addition to COVID, 2020 was an all-time record for the number of named storms, i.e. hurricanes, in 2020. So that's contributed towards, the sporadic outages of capacity, particularly on the Gulf Coast during last year. The early impacts of COVID were such that a number of refiners basically moved their planned shutdowns and turnaround maintenance programs into the second half of 2020, which has contributed also to the lack of availability of capacity in the short term. Then, of course, we had the famous Texas deep freeze of February, which knocked a number of plants on the Gulf Coast out of action for several weeks. And finally, the Colonial Pipeline hack, which at least knocked a couple of major base oil producers out of action for a short period of time. So we've had one series of events after another, none of which you could claim was predictable, but all taken into account collectively have continued to cause one series of untoward events after the other. And I think what I would like to say about this is that, a number of these are natural. In COVID, you can I don't know, however you want to describe it, as a once in a lifetime event, probably, but its duration is potentially significant. But hurricanes, deep freezes, and whatnot are natural factors which are probably contributed to by global warming. And if you believe in global warming, then the probability of these kinds of events recurring is perhaps greater in the future than it has been in the past. And which I think goes to the question of, how do base oil buyers react to, that future, given the probability of further untoward weather events occurring, and does that change their strategy for procurement because the perception of risk and reward in relation to spot versus term buying maybe change.
Exactly. It's something that, ever since the way we've been doing analysis, as you know, Ian, is inclined since COVID, has been working on scenarios more than ever before. And it seems to me that we have to be looking at, you can't sort of look at only one version of the future, right? We have to look at, COVID was completely unforeseen, but I think what you're saying here, and I think, many would agree, that the idea of more unforeseen weather events and things happening is a fact. And so understanding what, we can't kind of predict on a weekly basis when they're coming, but we can say that annually we are going to see more events. And so what is the impact of potentially cheaper spot pricing in the short term versus not being able to have product in the long term, and understanding, various scenarios around not just what the future looks like, but scenarios around how you're going to react with your planning.
Okay. Well, that's an interesting question. Let me try to respond to that. So first of all, if you can break down the components of that question, I think in terms of potentially controllable events, COVID is potentially controllable. I think weather patterns are not, and so let's separate those two. In terms of COVID, none of us on this call have any clue as to how long COVID will last. Are there going to be more variants that will come? Are any of them potentially resistant to the current suite of drugs and vaccines available? Who knows? Certainly, if you look at the history of pandemics in the past, they tend to have economic impacts that extend for several years. And I suspect that COVID is no different. But can you create a viable and sole scenario of COVID that will cover all eventualities? well, I think the answer has to be no. And so all you can do, I think, is to say, develop a set of scenarios under which, you look at the worst case and the best case, and how would your strategies differ between those two outcomes. I think the other thing is, the fundamental excess of capacity that has existed in the base oil industry has prompted a number of buyers to say, well, take our chances with the spot market, because we can probably get lower prices, and we'll take our chances because there's excess supply, so we'll never run into a supply problem. Okay, well, all of those strategic assertions have gone out the window in the last 9 months, and security of supply, of course, has become very valuable for those who are on contract business, who are maybe on allocation, as opposed to those in the spot market who are scrambling for anything they can get and paying over the market premiums for those spot supplies. So it does really, I think, cause you to, depending on whether you're a buyer or seller, to rethink your procurement strategy if you're a net buyer. This is something I think that will come out of this series of events, whatever the outcome, because I think, how do you value security of supply, right? It's really the question here, and how have the dynamics of the last year changed that, how you evaluate that. And I'm not going to, in this webinar, elaborate on that, but I think, it's certainly a question that people need to be asking themselves.
Yeah, yes, for sure. So Ian, I've got one particular question here that was submitted in advance, and I have to say, if there were prizes for best question, this might get it. So, so this one came in advance. It's quite complex, so I'll just read it in full, and then we might have to break it down into pieces. So here we go. In a post-COVID world where things have returned to normal, do you see the base oils industry returning back to very poor margins like in 2019? As refiners chase volume in an oversupplied market? Or do you see refiners chasing after value, given what they've experienced through COVID? Is a commodity always a commodity, even after COVID-19? So, yeah, so the first part there, when things have gone back to whatever normal looks like, do we see, the industry returning back to very poor margins in base oils? Or is it going to be turning to a value game?
Well, I think the first, I think you have to go back actually even before the first part of that question, which is, are we going to return to the new norm? I think what we've said is, in the short term, during 2020, it appeared that the lubricant demand returned to pre-COVID norms. But is that necessarily going to be the case once we've sort of restocked the economy? And I think we need another year to really form an opinion on whether that is indeed the case. We are thinking inclined, and we don't have, formal prognostications on this yet, but we're thinking that there actually may be a new norm here. that the longer COVID goes on, the more change economic and social behaviors become embedded in the fabric of how we work and live, and that could potentially influence lubricant and fuels demand in ways that we can sort of identify, perhaps initially, during the early stages of COVID, and then there was sort of a potential bounce back. But, are we actually going to continue sustaining that bounce back at pre-COVID levels, or is there actually this new norm? So I think, the first statement, do we simply return to pre-COVID norms? The answer is not necessarily. Okay, but even if we do, how is that pre-COVID norm going to play out in terms of pricing? Well, if that pre-COVID norm plays out in terms of demand returning to what it was, then we're going to be faced with a situation of oversupply once again. Now, there have been some selected announcements of plant closures, the most significant being, Shell's recent announcement to actually move up the date of closing the Bukom base oil facility from next year to this year. So that's the biggest one. But there need to be more. And I've been standing up on stages at ISIS conferences in the last 5 years, basically saying this. But the reality is that it doesn't always happen as the market might require. There are a number of reasons for that, and they are largely related to the power of the public sector, where very often the goals and objectives of publicly owned enterprises are different from the private sector. And the best example I can give you is Eni in Livorno, which Eni has been trying to shut that plant down for 10 years because it's old, outmoded, and unprofitable. And the unions will have basically prevented that from happening. So, are there more circumstances like that where Group 1 plants are controlled by the public sector, where despite the economic imperatives, they may be retained in operation simply for socioeconomic reasons? And if that happens, then we will simply perpetuate the oversupply of capacity on world markets, and that will contribute under most normal circumstances to a situation where most plants cannot cover more than their cash cost of operation, and in certain cases less than that. And so, I think certainly if we're speculating about, returning to a balanced market, we're going to return to a balanced market of oversupply. Okay?
Yeah. Okay. So then you're sort of saying that it's likely to go back to the sort of lower margin seen in 2019. And but when we talk about the value question, perhaps it's not as simple as looking at base oils as a whole, but by by group type and even at a grade level, product level. Because
ask me the second part of that.
Commodity always a commodity. So the second half is, do you see refiners chasing after value, given what they've experienced? Is a commodity always a commodity? And I think that's quite an interesting question when we see what's happening in various types of base oils at the moment, right?
Well, okay. Well, that's a very interesting question. I'm not sure I have a complete answer to that, but let me say this. What is a commodity? Okay. A commodity is a product which is indistinguishable between suppliers. In other words, that can be readily exchanged or traded between suppliers. That meets a standardized specification, and whose price is discoverable in real time on exchanges or some form of open market. Okay, that generally does not completely apply to base oils. Okay, so base oils are a somewhat differentiated commodity, but because of their excess of capacity. And the existence of some degree of price availability, not on an instantaneous, but certainly on a weekly basis. You do have a situation where I would say Group 1 and Group 2 are marginally differentiated commodities, right? Group 3 is not, at least yet. And it's differentiated largely by differences in quality and in approvals and in brand. Okay. Yeah. So certainly for Group 3, I think yes, I think there are ways in which that Group 3 can be decommoditized. Okay. Can you do that to Group 2 when essentially Group 2 is the bellwether material for setting prices of what I will call only partially differentiated commodities on world market? No. And Group 2 prices basically set the price of Group 1. The last 5 years, at the same risk grade level, between, let's say, solvent neutral 100 and 500, within that viscosity range, Group 1 and Group 2 prices are essentially the same.
Mm-hmm.
So, it's pretty hard to argue that with that massive amount of volumetric supply, that it's easy for anyone to differentiate their product, in an oversupplied market. I think that would be pretty hard to argue, unless you have a sufficiently differentiated product, perhaps in Group 3 plus, where some degree of branding and therefore decommoditization might be possible.
Good answer. On talking about Group 2 as being the sort of the bellwether, there's a question in the Q&A here, which may require a little bit of crystal balling, Ian. So based on the current scenario, when will prices of Group 2 stabilize, and on what level?
Okay. All right. Well, this is where you come up with a disclaimer about anything we say on prices cannot be held against us, right? and anybody who's from Exxon on this call automatically has to switch off their volume because they're not allowed to listen to this, right? Okay, well, that's always the question, isn't it? I mean, my answer is going to be this, all right? It depends. Okay, it depends on how long COVID lasts. It depends.
Yes, I think that's the point, right? Like, what should we be looking for to help us inform ourselves of the answer to this question? So yeah, exactly.
Well, but the biggest challenge, I think, is when our refinery operation is going to return to normal. Okay, and that is dictated by COVID. Okay, so again, I think my point here is that base oils are a tiny fraction of the oil industry. World oil demand, as I think I mentioned earlier, is around 93 million barrels a day today, and world lube demand is around, even if it's pre-COVID norms, is at 40 million tons, which is at 800,000 barrels a day. In other words, less than 1% of total fuels demand. So we cannot escape the conclusion that what happens to mainstream products is going to drive the outlook for base oils. Okay, it's not going to work the other way around, right? You can close a refinery and that will close the base oil plant, but if you close the base oil plant, that will not necessarily close the refinery, right? And there are different causes and effects here. So what I'm going to say, I think, is this: that what we've seen in the last 6 weeks, we've seen a leveling out of prices, maybe a little bit on the heavy side with bright stock. There's still some latent shortages. Prices have crept up a little bit, but on the neutrals, we've basically seen a leveling out of prices, and the market sentiment appears to be that buyers have kind of reached their point of pain, where there's increasing pushback on the levels of pricing that we're seeing right now. Eventually, that has to be passed on, and that I think suggests that we've reached a point at which we probably won't expect any further significant price increases. So the question is, when a price is going to come down, and what's going to cause that? Well, I think what I would say is, it may be not as fast as you might think, because we saw this very almost vertical spike in the premium of base oils over VGO, but it may not come back down so quickly, because it really depends at the pace at which mainstream refined products demand picks up, and that's we've seen certainly based on the numbers that I've been looking at. We lost about almost 10 million barrels a day of oil demand last year, in round terms, from 100 million barrels a day to 90. Okay, the first quarter estimates appear to be that we're recovering about 1/3 of that, with demand in the first quarter globally at around 93 million barrels a day. And if we continue on at that pace, we're not going to get back to pre-COVID levels of oil demand, perhaps until the end of this year. Yeah. So if there's any connection between what's happening to oil products demand and what's happening to base oils, one would suggest that it's not going to be an overnight change. In other words, we're going to see a gradual recovery in oil demand, and therefore in refinery runs, and presumably then in refinery profitability, which is going to occur over a somewhat longer period of time, a period of months as opposed to weeks. Okay.
Okay, good answer. Okie dokie. There's just a question in the chat that I will quickly address. That's sort of slightly, it's more about, it was asking about advising on future lubricant demand growth by region. And I think, not to say it's a little bit something we can't exactly answer in this chat today, but what I will say is about the way we are looking at lubricant, when looking at lubricant demand, more and more sort of total rolled up numbers are not sort of so helpful in helping business decisions, right? So we tend to think what's helpful is looking at you know, the by product, by sector, by, you know, we need to look at the demand in a more granular way to understand what's really happening, because I think that the actual overall growth in lubricants is hiding a lot of activity within the different types of products and sectors. And so in order to understand what's happening, the top line is perhaps not the most important. But anyway, that's just to address that question that we had in the chat. Okay, I have another question, Ian. We've got around 15 minutes left. We can certainly feel free to add some more questions to the Q&A, but I've got a few more here. We just saw Ian recently announced in the last day or two that Gen 3 oil, or Regen as they've been renamed, has signed an agreement with BP, so that BP is going to take all their re-refined product out of this plant in the US Gulf Coast. So my point of raising that is, what is the outlook? What's, you know, what is the this renewed or new or renewed, depending on who you are, interest in re-refined base oils? How does that play into all the complexities that we've just been discussing?
Yeah, okay. Yeah, actually, if you go back to that original figure, you will see that if you look at the pie charts between 2000 and 2020, there was a significant growth in re-refined product. So I think if you that bright green segment is re-refining, which as you can see, well, visual, it looks like about 3x growth. So very significant increase in the market share of re-refining. And why is that? Well, a number of reasons. First of all, we have better technology in re-refining these days. We have, you know, increasingly hydroprocessing based re-refining technologies that can produce group 2 or even group 3. We have better quality used oil because the quality of lubricants has been improving, because the raw materials, which are virgin base oils, the quality of those is being increased, as you can see from the shape of the pie chart. We've got more and more group 3 and group 2 going into lubricants than we did 20 years ago. So the quality of used oil, which of course represents those same components, is improving. And so it's easier for re-refiners to make higher quality base oils, but simply because the quality of the raw material is better. The next point, I think, is that certain players in this industry, not consistently worldwide, I would have to say, but I think the awareness is growing, is that major lubricant marketers recognize that sooner or later, depending on where they are, they're going to be increasing pressures on what we call EPR, or extended producer responsibility, which means that you have to have some form of custody over the value chain of your product. Now, that doesn't necessarily mean that a BP will go out and collect used oil and process it itself, but it will cause that to be done. Okay, and so I think it's fair to say that all of the major marketers worldwide, lubricant marketers, are in various stages of really trying to figure out what their positioning is with respect to re-refining. Does it make sense for them to be investors themselves in re-refining? Probably not. These are relatively small scale operations. You know, the collection or the supply chain for used oil is one which is highly decentralized, and one which, you know, a major oil company would not be efficient at managing, given the overhead they'll generally tend to bring to that activity. So it can be left to specialists in the private sector. And the question is, how do these major marketers actually, you know, maintain a chain of custody of the product and be able to prove that that product is actually recycled, and yet, on the other hand, you know, to outsource that to third parties. And I think there, what we are seeing is the growth of what I will call responsible players in the re-refining industry, who previously, you know, didn't or really substantially didn't exist in the past. So the re-refining industry made a bad name for itself, you know, by you know, a history of underperformance, both on product quality and financial reliability. And only in recent years have we begun to see the emergence of what I would call highly reliable public companies, such as Safety Clean in the United States, or Pure Globe in Europe, which have the financial wherewithal to survive ups and downs in the market, and therefore to bring a degree of professional management to this business, which really didn't exist before. And that, I think, has encouraged major players who have previously, you know, said, you know, we don't blend re-refined lubricants in our re-refined base oils in our lubricants, to now a situation of, yeah, well, we'll look at that a little more carefully than we did. BP's really been at the forefront of this. Valvoline, another major marketer, that launched a product containing re-refined oils almost 10 years ago. And so this is a segment of the business that is responding to sustainability initiatives, and one which I think we need to watch very carefully for new opportunities. And this move by BP there's always a question about whether that project is appropriately sized or economically structured in an appropriate way. But certainly, I think it's a good sign that the majors are paying attention to this space.
It's certainly a combination of things that mean it's certainly more viable now to be producing, you know, finished lubricants with re-refined base oils, right? I mean, as pressures to decarbonize, and I'll be speaking with you know, Jana Wilkinson, our vice president of the practice, on this topic and more at the next session, actually, as we look at some of the specific levers that have been pulled to decarbonize our industry. Okie dokie. There is actually one more specific question on re-refining that I have, which is specifically, what's the outlook like? Excuse me. What does the outlook look like in Europe for re-refiners, Ian, specifically?
Oh, well, we already have a well-developed re-refining industry in Europe, both in countries that allow the private sector essentially to find its own way, as well as those, you know, tending to be in Southern Europe, where you have, you know, systems which provide subsidies to enable the recycling of used oil. What we've seen in recent years is, you know, that there have been moves to basically shut down a number of, you know, the older outmoded technologies, for example, in places like Greece. On the other hand, where we're seeing new plants coming, for example, one just going in Turkey, which I think started up last month, which are, you know, bringing, you know, new technology to Group 3 and are ultimately Group 3 capable in the industry. So I think Europe, you know, has been really at the forefront of promoting re-refining, largely through EU sponsored initiatives. but the challenge I think that Europe has had is that the EU directives, while focused on the ultimate recycling of used oil, allow the actual mechanisms of how those sort of broad-based policies should be managed to the individual countries, and the response of individual countries has been quite different, unfortunately. So the principles are there, but the practice, of course, varies significantly between countries. So unfortunately, Europe, it can't be thought of as a monolithic lot when you come to talk about the opportunities for this segment.
Okay, yeah, sure. Okay, well, we're about 5 minutes away from the end of our time commitment. I think that the questions have sort of slowed. We've answered the majority of them. I think if anyone has any last ones, feel free to pop them in the Q&A. But I think before, the way that I think might be best to close out, Ian, is that really we're still in a time of uncertainty, and none of us really know. We all know that our outlook is all attached to COVID, and none of us are really COVID experts. So what we really need to be doing, and what I've heard you talk about today, Ian, is what signals do we need to be looking for to try and help navigate us through this. And I think you kind of touched on that a little bit with one of the questions, but I thought maybe to close out the session, how do we, what's our recommendation to people what kind of signals should they be looking for to help guide them in the next, the sort of next 6 to 12 months, which is going to be a very uncertain time for people?
You mean apart from picking up the phone and calling Klein and asking us to help them?
Yes, exactly. I put our phone numbers up at the end.
Okay, all right. Well, I think let's go back to first principles. I think what we're saying is, the lubricants industry thrives on stability. Okay, because supply interruptions in a product as valuable and strategically important as lubricants is not desirable. Okay, so a certain degree of redundancy in the lubricant supply chain is necessary in order to maintain the security of supply. Okay, that's accepted. What we've seen in the last year has completely upset that mindset, right? And so I think the challenge here is to say, do we really need to rethink how we value security of supply as a lubricant marketer? How do we think about the meaning of security of supply, given what's happened in the last year? Do we need to have redundant sources of supply? Do we need to have excess storage? Do we carry more inventory? How do we restructure our contracts with suppliers to ensure a greater degree of supply security and or price risk management than we had before? And conversely, from the standpoint of suppliers, what do they do to assure buyers that they have the ability to supply, come hell or high water, after the evidence of last year? Not sure I can answer those questions uniformly for everybody in 2 minutes here, but to me, risk management has surfaced, I think, as an outcome of these events, which any supplier or buyer in this market should really be rethinking based on the evidence.
Exactly. Of course, it's up to everyone to put their own business in operation in the context of obviously everything we're discussing today. And as you say, we are more than happy to help do that with various companies. Okay, I think that is coming to the end of our time, so I'm going to wrap up here. As Vera said, the recording will be shared with all participants, won't it, Vera? And
we usually share them upon request. So I suggest if there's interest, just to email us at that webinars@clientgroup.com email, because that's the email that you're going to receive the follow-up from.
Sure.
Just reply to that. Ask any questions that you may have after this. Request a webinar recording, and it will be done upon request.
We can also share the PDF of Ian's article if you want to, if you haven't read it and want to read it in its entirety, his paper, I should say. It's really more of a paper than an article. So yes, happy to share that as well. And I will quickly share the obligatory contact details of our team here. That myself and Ian on the call, and Deanna Wilkinson, who's the head of our practice. So Ian, thank you very much for being my first guest on In Conversation With. As I say, next month, 15th of June, I'll have Jana Wilkinson, and we'll be talking about sustainability. And thanks, Vera, for setting us all up today. So thank you all for coming and contributing, having your questions from the boots on the ground in the business. Just makes this a lot of fun for us, and we really enjoy it. So thanks for adding those questions, everybody.